Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hey guys. So we're going to start today by finishing off that last slide of the lecture. Once we've done that, we're going to go into our first assignment workshop. The assignment workshop is essentially an introductory workshop where I'm going to give you an overview of the tasks you need to complete, some pointers on how to get started if you haven't yet got started, and if you haven't, I do recommend you start soon. And then essentially, if there's time, I'll just open it up to the floor and answer any questions that you guys have. Remember, when it comes to the assignment workshops, there's a couple of things I want you to keep in mind. The first is that the goal of the workshops is not to show you how to do the assignment to come to an exact asset allocation, right? Number one, it's not about me doing it for you, but number two, there's also no one right answer. And I highly suspect that I'm not even going to have two groups with the exact same asset allocation, because even if two groups use the exact same quantitative method, make the same data decisions, have the same assumptions, and apply it in the same way, they probably won't make the same qualitative adjustments. So I don't expect any two assignments to be alike. There is no one correct asset allocation for either client. What matters is whether your analysis is technically correct, sensible, your assumptions are justified, your qualitative arguments are reasonable, and they're expressed well and written up in a professional report. Right? Two completely different allocations for the same client might both get top marks if it's done in an equally robust, well-explained, well-presented way. So that's the first thing. The second thing is I fill the assignments with issues that I've experienced in the past students face, and will continue to do so as much as possible if I'm not getting questions from you. But if you guys do have an issue that you'd like me to bring into the assignment, please do either come and see me or send me an email. Don't send me an email Wednesday morning to include in the assignment that afternoon. There is obviously going to be a bit of a lag while I incorporate it into the workshop, particularly when that involves any kind of Excel demonstration. But so the earlier you can let me know, the better. The other reason why it's good to get on top of the assignment early is you guys have probably noticed with your Excel work, you might read the Excel outline and look at the analysis file. You might even attend a tutorial. But if you haven't done the Excel work yourself, it's really hard to know what you do and don't understand. Right? Seeing isn't doing with Excel. So it's only if you start to get your hands dirty and do the Excel analysis early that you'll start to identify what problems you have. And you don't want a situation where you're coming to me with all of your Excel problems in week 10. At that point, you should have done your Excel work. You should know your initial quantitative allocation, and you should have the framework ready to make the qualitative adjustments that will feed back into the model. So getting on top of things early will help in that you'll get the most out of me in the amount I can help you, and it will mean that you're not left writing up the assignment in the last few days, which is going to cause issues because the assignment needs to be polished and presented like a professional report. So keep those in mind. The other thing to keep in mind is I do these assignment workshops so that you guys can all, as much as possible, get consistent help from me. I do know that there are groups that are very comfortable asking me for advice, and I think that's great, but I know there'll be other groups that won't want to, and they'll still have issues that they want resolved. So this way I can give you guys relatively equal information, but I do want you to therefore listen to the workshops if you miss it and use that information, right? So don't come to me and say, but I had no idea that I was supposed to do that, if the answer is, well, but we went through that in the assignment workshop and you haven't watched the recording. Obviously, as usual, if there's ever a recording issue, I will retape it. All right, now before we go into the assignment, let me just quickly finish off this slide. Remember, we finished our fixed income topic yesterday by just going through some of the potential active strategies that you might take in fixed income. We finished with this top one here, that was corrected at the last minute, which I'm very pleased about. And that is interest rate anticipation. Remember, we said if you think interest rates are going to rise in the future, it means you predict that bond prices will fall in the future, so you sell before that happens. If you think interest rates will fall in the future, it means you expect bond prices to rise, so you buy it before the rise and you can profit on the increase. The next thing that's very common when it comes to fixed income investing is what we call yield curve positioning. Now, let's say we are currently facing a fairly steep yield curve. This is time, yield to maturity. And it's fairly steep so that the yield required for a long-term bond is significantly greater than the yield required for a short-term bond. Let's say that you predict that the yield curve is going to flatten. You don't necessarily know exactly which way it's going to flatten, right? I mean, there are actually three ways that this could happen. One is that the short-term yield stays relatively consistent, but the long-term yield drops. That'll flatten it. The long-term yield, so one is that essentially this could happen. Another is that the long-term yield stays consistent, but the short-term yield goes up. Or both could happen. The long-term yield could drop, the short-term yield could rise. Now let's actually assume that that last one is going to happen. So let's say you predict that the yield curve will flatten by rotating essentially in both directions. It means that you predict the long-term yield will fall and the short-term yield will rise. If you think the long-term yield will fall, what do you think will happen to the price of the long-term bond? It will go up. So what would you do as a strategy before that occurs? Yeah, you would buy the long-term bond. And if you expect that the short-term yield to maturity, will rise, then you expect that the price of short-term bonds will fall. So what do? Sell. Or if you don't own, you short sell. This is what we consider to be a relatively market-neutral strategy, because it doesn't matter whether in general yields are rising or falling, you're actually predicting a rotation of that curve. So it means that, for example, as long as it flattens in some way, you'll still make money. You might expect that this will happen, but if you're wrong and short-term yields stay fairly similar but long-term yields drop, that's fine, you're going to profit from this position. If you expect long-term yields, if it turns out long-term yields stay similar and short-term yields rise, you'll benefit from this side. If you expect this to happen, but instead short-term yields do rise to, say, here, but the yield curve flattens and longer-term yields drop by, let's go here, more. As long as it flattens, that's fine, because you're going to gain more on this position than you'll lose on this position, right? So essentially, as long as the curve flattens, even if you don't gain on both sides of the trade, you'll, worst case scenario, gain more on the winning side of the trade than you'll lose on the losing side. But of course, in order to execute that, you need to be able to short the bond or sell it if you own it. So that's another strategy that's quite popular. You might have a macro-driven strategy in any number of ways. You might make a bet on a particular sector, you might make a bet on the bonds of a particular country, or you might invest in bonds with a currency bet as well, although that's more rare in fixed income. You might make a relative value trade, and these focus on spread. It might be spread between different corporate bonds, bonds in different industries or in different sectors. So for example, let's say that you are looking at the yield spread of Rio and BHP. And at the moment, the yield of BHP is above the yield spread of Rio. But you think that they have relatively similar credit risk, and you think their yields should be relatively similar as well. So in time, you expect them to converge. Now, I can't remember what I said, so let me actually focus on it by writing it down. Let's say you think that all right, so I said the yield spread of, I can't remember what I said, let's say BHP is greater than the yield spread of Rio. You think that they will converge, and you want to therefore take a long-short portfolio, a combined trade, right? So what would you do? If you think this is what currently exists, but in time they will equal, which one would you buy? Rio, right? Because if you think the yield spread of Rio, hang on, you think the yield spread of Rio is currently too low, right? So you expect this yield to rise, which means you expect the price to fall. So what would your position be? Short. You expect the BHP yield to fall, therefore you expect BHP price to rise, so you go long. And as long as they converge in whatever direction it happens, if they converge, you will profit on at least one side of the trade. By the way, when it comes to any kind of yield bet, it does actually help to write it down, because then you can actually go first, what's going to happen to the yield, then what's going to happen to the price. It's whenever you have to flip something in your head, I don't know, if you're anything like me, it helps to visualize it. So all of these sort of relative value spreads are all about betting on convergence. You might have issuer-based selection. So is issuer quality properly reflected in their spread? Let's say that there's currently a company that is fairly new and the credit rating agencies aren't ready to give it an investment grade, right? They're not ready to confidently say that they have an above-average ability to meet their commitments. So they're currently in junk bond status. But you believe that they are a good company, they have solid prospects, they will generate strong cash flows, and they will be able to meet their interest. You don't think they're going to default. But at the moment, they're junk. So you buy that stock, you're getting a you buy that bond, you're getting a high return because they do have a low credit rating and therefore are priced for high credit risk. And then, in time, the credit rating agencies will recognise that they're investment grade. So they upgrade them to investment grade. What's going to happen to the demand of that bond? Increase. So what's going to happen to the price? Increase. So you sell it, because remember, the second that you have an investment grade security, there's a lot more people that can invest in that bond. So demand goes up, price goes up, you can sell it at a profit. In the meantime, you've been getting a good return due to the high credit spread because it's junk. Okay, so that's an issuer-based selection argument. And you might have structure bets like liability matching. So you might have a separately managed mandate where a defined benefit fund or a long-tail insurance company have said, look, this is what our liabilities are expected to be. Analyse those and create a portfolio of assets where you think the duration will match the duration of the liabilities. It's a bet because it's never a sure thing, either on the asset side, if you have any equities, for example, they're uncertain, or on the liability side, because that can change through time. Okay, so all of these are just different ways to create value from fixed income. And I won't expect you to go into detailed definitions of how each one works and how profitable it is, but it's good to have a general idea of the type of thing you can invest in. Now, any questions on that or on the fixed income topic in general? Okay. So, the assignment. Now, hang on. That's the assignment workshop. Here. Great. So what we're going to do today is just sort of have a broad overview of what the assignment involves, some of the tasks you'll need to complete, and in doing so I'll give you some pointers of things that you'll need to do in case they haven't occurred to you already. Now, hopefully most of you have at least started to set up a framework or think about the decisions that you might need to make in the assignment. So some of what I'm going to tell you might have already done. Some you might think, oh no, I might need to adjust my Excel analysis. So the first thing I want to say in terms of advice, when you set up your Excel spreadsheets, remember everything has to flow through from one tab to the next. So for example, you've got your yearly data, you've got your quarterly data, and from one of these, whatever method you choose, you will calculate returns. You will adjust the return in line with expectation. That will feed through to an adjusted return tab. I might use this one as an example. So you've got a return index from which you calculate returns. In this tab towards the end, this is Excel video 2. You will adjust expected returns. That will lead into, for example, a solver analysis from which you will get your output. You need to make sure that all of these sheets flow through to your base data, which is in this tab here. Do this for 2 reasons. One, because your marker will need to check that you have calculated everything correctly. And it's impossible to do that if you value paste any cells in. So when your marker assesses that you do the correct method, everything needs to flow through. The other thing logistically for you guys is, let's say that you have adjusted the returns using an arithmetic mean. And in next week's workshop, we talk about why you might need to use a geometric mean to have the conversion. If you value pasted it in, you need to redo it all. Instead, you go to where you've done your return adjustment and you fix the method that you did, and then you just add everything linked so it flows through. It's much easier to adjust things when they're properly linked. So set up your Excel analysis from the beginning, making sure that everything flows and it makes sense. We're going to talk, for example, next week about how to backfill hedge fund data. And I've put a note in that in the workshop today. I'll come back to this, but the reason that's important is that hedge fund data starts in the year 2000. I'm going to show you how to backfill it next week. It's a bit earlier than I'd like because we don't look at hedge funds until week 9, but I want to show it to you in week 8 just because I think it's good to get the quantitative analysis done early. But knowing that, even though you don't yet know how to backfill the data, you might want to leave a gap there for your hedge fund returns that you can backfill later. And as long as everything's linked, the sheet will populate. So a lot of the initial work with Excel is making sure it's set up in a way that's sensible. By the way, just in case anyone isn't sure what I'm talking about, what I don't want you to do is what we call value paste the data. See how in this cell, I can see how the return is calculated? What you don't want to do is that. Same number, but I can't see what you've done. There's no way that your marker, which is going to be probably one of your tutors, there's no way that your marker is going to want to see that number and try a bunch of different formulas until they can get it to equal that number. It's not going to happen. If you value paste something in, they're going to have to assume that you didn't do it correctly because they can't see that you did a lot of the time. It's really bad practice to hard code anything in. You've got to let it all flow through the spreadsheet. All right, so we're going to talk about what's required, tasks you need to complete, and some approaches you might use, and I'll give you some pointers to help you get started. Before I begin, are there any questions to start us off? All right, so let's start with what the assignment actually involves. The big output, what Robert and Abigail have asked you to do, is to recommend an asset allocation for them. So the key output of the assignment is you need to recommend for Abigail a specific set of weights that she should change her portfolio to, and another specific set of weights for Robert. They should not be the same. If we have a look at the two clients and their objectives and constraints, you'll see that they're very different. Of the two, which would you argue is more risk averse? And remember, I haven't given you a utility function here, but look at the wording of what they've asked you to do. Okay, let me ask this in a slightly different way. Let's say that you're setting up solver analysis and you're going to try to not even trace out efficient frontier. You're going to tell solver what to do to get a portfolio. What is the first decision you need to make in that solver tab when it comes up? So, it could be, that's one of the two, one of your clients is. Let's go, hopefully it's actually installed. Where does solver come in? You'd think I'd know it. Isn't it data? Data, right? Is it not there? Damn, the add-in isn't there. Okay, so what have I done? Okay, I'm just not going to touch that. I don't know how I just made that disappear. All right, so solver comes up. I know. I did a screenshot. Hang on. When we use solver, and that's Excel video workshop week 3, I think. Yeah. Nope, that's random number generation. Beautiful. This is what comes up, right? And what's the first thing you need to decide? What are you telling solver to do in this top section? Which one's ticked here? Minimize, right? What are you minimizing? Vary. You're minimizing variance. Then, when you work up for this particular constraint, you add in a bit more return, but you're still minimizing variance each time. The alternative is you might maximize something. What would you be maximizing? Sharp ratio is one. What is it for Robert, or is it Abigail? Let me check. What might it be for Robert? Have a look at A for Robert. Return, right? So what we've got here is Abigail is saying, I want a return of at least 6.5% per annum, but providing that you achieve that for me, I just want you to minimize risk as much as you can. What Robert says is, I have some constraints. I need for example, standard deviation. I have a maximum standard deviation. I have a probability of loss constraint. But if you achieve these, I want you to give me the highest possible value. So one of them is asking you to minimize risk as much as possible. The other one is asking you to maximize return as much as possible. So arguably, which would you expect might be more risk averse? Abigail, right? There's no way that with completely different worded constraints, they would have the same portfolio, right? So that's the first thing you need to recognize. If you recommend the same portfolio for each client, you'd have to argue really strongly that even though one wants to maximize return and the other one wants to minimize risk, it's still appropriate for both. So the key output is, this is the portfolio I recommend for Abigail, this is the portfolio I recommend for Robert. In terms of how you're going to have to do that, you're going to need to, first of all, do quantitative analysis that's going to generate portfolio measures. That quantitative analysis, you're going to use a lot of what you've done in, for example, Excel Video 1, where you've learned how to generate portfolio measures like the arithmetic mean, the geometric mean, probability of loss, standard deviation. You might do it through a bootstrap. And the way you'll do it, you're going to link in other Excel videos as well. For example, you might use Solver. We learned how to do that in Excel video 2. Wrong one. Once you've generated portfolio measures from your initial quantitative analysis, you then need to move into qualitative reasoning. Right? Because remember, we said that the computer, the data, there are some risks that aren't reflected in what a computer can tell us. And there's other things that a computer can't decide. Is it too difficult to manage? A computer isn't going to tell you that. Is there data smoothing? A computer won't know. You need the oversight of common sense, intuition. A computer might tell you to invest in fixed income, but it won't tell you whether it's feasible to do it and how you might go about it. A computer might tell you to invest in hedge funds. It won't know whether or not you're a high net worth individual. So you never rely on the numbers to make the decision for you. The next thing that they specifically asked you to do is to adjust that asset allocation that comes from the quantitative method using qualitative considerations. Now, when you do this, please make sure you give a reason. Don't say the computer said to put 40%, or sorry, not the computer, the solver analysis, the mean variance optimization, whatever you've chosen, has told me to put a 40% weight in Australian equity. I've changed it to 30%. Why? Right? It doesn't matter that you change it. It matters why you change it. So every adjustment needs to have a rationale that needs to be carefully expressed in the report. Because otherwise, Abigail's going to sit there going, for example, I mean, all right, well, the method that you set up told me to put 40% in Australian equity. Why are you overriding that? You haven't given me a reason. Okay, so the adjustments, it's very important to set out the rationale. That's going to give you a final recommended portfolio. Those final weights are going to be plugged back into your quantitative model to generate portfolio measures that should satisfy the client's objectives and constraints. Now, in the assignment, I've given you this output template that if you could fill in this way, it would help your marker. Because your marker is going to need to check that, one, what is your portfolio for each client? How does it compare to the comparison group? Have you actually met each client's objectives and constraints? If you do it in this table, they'll know exactly where to look, so it will be a very easy process for them. But that said, I don't want to constrain a single thing about how you present the details. So if you think it could be better done in your case by changing this table, expressing it in a different way, that's totally fine. But all of the information that's contained in this table is needed for your marker and it is needed for your clients, right? So you can change the table, but this information needs to be in the assignment in a very clear way. What you'll find is that there's a lot of flexibility in what you do and how you do it, because that's exactly the way it works in the industry. Okay, so you've arrived at your final recommended portfolio. You then need to write a report to explain the analysis and the recommendation. Now, the report should be standalone and it should be written as a business report. If we start with standalone, and I've noted this in the assignment outline, what I mean by this is when your marker is marking your report, they should not need to look at the Excel file to understand what you've done. And what I tell them when it comes to marking is, if you read the report, if there's anything that you don't understand and you need to open the Excel file in order to understand it, that's where you deduct marks, right? Because your method, your reasoning, everything needs to be expressed within the report in a way that the client can understand. The reason I do this is exactly what happens in industry, right? Your bosses are not going to want to dig through your Excel file trying to figure out what it is you've done in order to understand what you recommend. They don't have the time to do that. They're running a number of different processes at once. They're going to want a report that is clear, that sets out your assumptions, that explains the key outputs, and that identifies any methods, any assumptions, anything critical to the analysis, right? So they can look at a couple of pages and go, yep, I know what you've done, I know why you've done it, and I know what you're recommending. So the marker will go through your assignment first, and they should understand everything they need to mark the assignment within your report. Then they open the Excel spreadsheet to check that you actually have done what you've said. Okay, so they will mark your Excel work, but they shouldn't need to look at it to understand what you've done. Does that make sense? Great. So that's what I mean by standalone. When it comes to writing it as a business report, that means that it is important that it looks professional, it is neat, it is well written, and it is well set out. If you have a look at the marking guidelines, effectiveness of communication is given a 30% weighting, right? So yeah, a lot of your mark is going to depend on your analysis, but it's also going to come back to, does this look like a professional report, right? Anything that looks like what I give you, like just black text on a white page, that's not the way it works in industry. It's not professional, right? Make up a name for your company. Make up a colour scheme. Have a title page. Have a table of contents. Make it pretty to look at. Make it easy to follow. Make sure all your fonts are big enough to read, right? Your markers aren't as blind as I am, but you don't ever want to have to sit there trying to squint to read a legend on a table, for example. And please take the time to carefully proofread your work. I don't know about you, but if I ever read, for example, an analyst valuation report or a news article, if you pick up a grammar mistake, if it's badly written, you're not going to have any faith in that, right? Now, I'm not saying it needs to be perfect, but often the difference between a well-written and a poorly written report is whether you are actually getting the writing done in the last few days, right? It doesn't need to be poetry. It just needs to be well spelt. It just needs to be well laid out, because you want the reader to have faith in your ability, and that does, at the end of the day, the first impression they're going to get is they're going to stare at your report, and you don't want it to look messy. So I keep emphasising this because inevitably I will get reports that are really well analysed but really badly written, and in industry it just wouldn't cut it. I don't know if I've told you this or not, but one of my girlfriends spent years in sort of charity work, and then she moved to EY, and she spent the first month taking a bunch of reports that were already written and converting it into EY reports with the right font, with the right colour scheme. And she's like, seriously, I'm not actually adding any value because the content's the same. But she actually is, because their clients expect the detail to be communicated in a particular way, right? So presentation really matters in the industry. With that, please stick to the requirements. You've got a 3,000 word count, 14 pages, which is about 4 to 6 pages of typed text, and therefore leaves a lot of room for tables and charts, right? Typically, it does help to have a bit of colour in a report. Asset allocation is beautifully presented in a pie chart, and I'll talk about that in later weeks as well. So if there's something that you think is better expressed as a graph, do that, right? You've got the room. Now, it might seem like 14 pages is a lot. Funnily enough, I think it might actually start to feel a bit tight, because you are going to do a lot of analysis and have a lot of tables to report. There's two ways of going about it. If you can write economically, simply, to the point from the beginning, then you're wonderful writers, and you should do that, and then you'll never need to rein it back in. If you're anything like me, you're going to write far too much to begin with as you put in everything that you think might be relevant, and then you're going to go through a painful but important process of actually looking at the 30 pages you've written and said, what is needed, what is unclear. If it's unclear, fix it. If it's not needed, remove it. If you've repeated yourself, remove it. If you're writing inefficiently by too many descriptive words, cut it back, right? It's a painful process to do, but it is really important. I remember I did a report for the Treasury a few years ago, and I wrote a 30-page report in about 3 to 4 weeks, and I spent the next 3 to 4 weeks cutting it back to about 1/3 of its length. The end report was a lot better because it was clear, to the point, and didn't waste the reader's time. Okay, so make sure that you stick within those limits. So that's what's required. In terms of the actual specific tasks, the first thing you need to do is identify the client's objectives and constraints. Luckily, that has been done for you. It's all set out here. but it's important to acknowledge them in the report and not to miss any. So, for example, a lot of these are numerical, but some are qualitative. For example, both clients have asked that you consider how difficult it is to manage their portfolio. They're willing to pay for professional help, but only if there's net benefit. So both of those, one, difficulty to implement matters, and two, cost-benefit analysis matters. It doesn't need to be a detailed quantitative cost-benefit analysis, but if you're going to recommend an expensive asset class with an expensive implementation, like a private equity fund of fund where you've got a dual layer of dual fees, you need to make sure that you acknowledge that that's expensive and justify why you think there's net benefit. So that's the first thing. The next thing you need to do is decide your approach. So what frameworks will I use? How will I identify the portfolio for each of your clients? The first thing you have to do is a quantitative approach. I'm going to come back to that. The second thing you need to do is to make qualitative adjustments. And in this assignment, I decided to actually specify those two steps because they are so important. And so I wanted to make sure that every group did go through that process because I haven't in the past, and sometimes people have just sort of forgotten the qualitative analysis. And I actually think that limits your learning because, you know, all I can really do is not give you a mark for the qualitative analysis, but if you'd gone through it, you would have learnt a lot more, right? So I've actually specifically said you need to start by doing a quantitative framework, but you then need to adjust it using qualitative considerations. Funnily enough, the qualitative adjustments, most of the time, they're what make the difference between a good assignment and a great one. Because I find that groups are pretty good at doing that quantitative analysis. There might be a few errors, a few incorrect assumptions. They might focus on an arithmetic average when both the clients are accumulating wealth, so it should be geometric. I'll talk about that next week too. But at the end of the day, people do a pretty good job at the quantitative task. Where they fall down at times is the qualitative analysis. And sometimes it's as simple as just not really bothering to do a lot of qualitative analysis. Sometimes they've made a lot of changes, but they haven't justified those changes. And sometimes they've made qualitative adjustments by some really crazy assumptions. Like, for example, I don't think a crash is going to happen. So I've actually said, let's put everything in equities, changed all the probabilities, and adjusted some of your expected return assumptions as well, right? So they've made changes, but they weren't really in the spirit of what the clients wanted. So really do pay attention to that qualitative side. It matters a lot. So you might be looking, for example, at the subjective understanding of your asset class, subjective adjustment based on the understanding of your asset classes that we're gaining through the course. Direct property, private equity are appraisal-based. So that means that there's data smoothing, particularly if I use quarterly returns. So if I have a quarterly return method, it will be very important to consider, is my weight in appraisal-based assets too high because of data smoothing, because they're only valued once a year? If you're analysing an illiquid asset class, same thing. If you're looking at hedge funds, is it feasible for my clients? And even if it is feasible, do I think that the hedge fund fees are going to eat away the potential alpha of the strategy? We're going to look at that in week 9. So that's why I say you've got to get your quantitative analysis ready first. Then you'll start to make qualitative adjustments. Probably as the weeks progress, you'll add in more qualitative adjustments as we go through more asset classes, and that's fine. But it means you want to get your quantitative analysis done early. Now, one thing I want to call attention to with the qualitative adjustments is inevitably, if you guys choose to use Solver to get your quantitative asset allocation, the second you make a qualitative adjustment, the numbers will look slightly less good, right? Because Solver has, by definition, given you the best output based on numbers alone. But the whole point behind qualitative adjustment is that there are some things that the numbers don't tell you. So if you identify, for example, a concentrated fundamental risk exposure with the profit share, and therefore make an adjustment out of equity into another asset class, the numbers will probably go down a bit, but as long as you're still meeting the client's objectives and constraints, that's fine, right? Because you're saying that you're making a change because there are some things that aren't reflected in the numbers. Does that make sense? Don't make such a big change that none of your objectives and constraints are met, right? Because then you've lost the quantitative focus and just gone with qualitative. But don't freak out when the numbers look a little bit less good. That is always going to happen by definition, or Solver wouldn't be working properly if that's what you're choosing to use. You might look at things like the arguments behind the two-stage approach, the qualitative step 2 of the two-stage approach. You might look at the fundamental risk approach. And so I've said here what I just said before. Remember, you still got to satisfy the objectives and constraints. If you can't hit every single one, if you end up breaching a constraint, it's not the end of the world as long as the constraint breach is only minor. But if you do that, acknowledge it in your report. Right? If, for example, let me get one. So if Abigail has said that standard deviation is no more than 8% per annum, and it's 8.01 or 8.05, it's not the end of the world, but you don't want to say, we've done a portfolio that has satisfied all your objectives and constraints when you haven't. Because if you do that, she's going to say, well, you lied. Like, you know, I can't rely on what you've said because you've said you've done everything I wanted, but you haven't. Whereas if you say, we have broadly satisfied your objectives and constraints, noting that standard deviation is slightly higher than what you said as the maximum. However, the margin is low and we believe that this portfolio is the suitable one for you for these reasons. That's fine because you've acknowledged it. So she doesn't doubt what you say. It's all about trust. For your quantitative analysis, a few obvious things to get you started. The first is that your clients have different investment horizons, so you need to set up a separate analysis for both of them. For Abigail is 4 years. Robert has a little longer till retirement. He is 6 years. So don't use the same spreadsheet for the two clients. You can use the same expected returns because they do expect the same returns. So you don't need to adjust the returns because they are expressed as annual measures. That's given to you here, and it's the same for both. But you do need to express the fact that there are different holding periods for the two clients. So if you're doing a bootstrap, Abigail has a 4-year bootstrap, Robert has a 6-year bootstrap. You need to generate portfolio measures that align with objectives. A lot of those portfolio measures are done in video 1. Some you'll need to modify, some are slightly different, but what you've learnt through your Excel work is enough to get you to understand how to do the measures, even if they require small tweaks. Nothing's identical to your Excel work because we're trying to get you to apply it in a new environment. You need to pick a quantitative analysis method. That might be a 4 or 6 year bootstrap. It might be historically based hypothetical rolling outcomes, right? There you're just saying that the past occurred, you think the future will occur in the same distribution as the past. You're not running a bootstrap to generate more data. Now remember, when you pick your data frequency, make sure it makes sense for the method that you use. If you're going to use a historically based hypothetical portfolio and you use yearly returns, you don't have a lot of data points to work with, which is going to undermine the statistical reliability of your tests. You might be better using quarterly returns if you do a rolling hypothetical portfolio. But if you do a bootstrap, yearly's fine because you're generating more observations. And the benefit of yearly returns for a bootstrap is a bootstrap assumes that returns are independent through time, no serial correlation, for example. That's never going to be met exactly, but there's typically more serial correlation under quarterly returns because of things like thin trading and appraisal valuations, which makes yearly returns in a bootstrap more sensible. I'm going to come back to those next week as well. If you want to do parametric analysis, which is more rare because it assumes things like a normal distribution, you'd look at Excel video 4. I'm not a massive fan of it, but that's fine if you want to use it as long as you justify why you're doing it and acknowledge that that, like any other method, will have potential shortcomings, and you want to discuss those and how it might affect your analysis. You need to decide, am I going to use Solver? The benefit of using Solver is you can just hit a button and you can incorporate pretty much every different objective and constraint into Solver. So it is quick to use, but it is prone to things like error maximization. So you'd need to be aware of that when it comes to your qualitative adjustment. Or you could manually adjust like a portfolio analysis workhorse. That means that more reasoning goes into each adjustment, but it will take you a lot longer. So it's up to you. Most groups tend to use Solver. That's fine as a first step, as long as you adjust the output carefully and you recognize not just, for example, what are some fundamental risk exposures that are in there, but what is some problems with the output because I've used Solver, which is an error maximizer. By the way, if you use Solver and you choose to put every numerical objective and constraint in there, so you might say to Solver, I want you to maximize returns subject to this tracking error, this probability of underperformance or probability of loss, this percentage maximum in illiquid assets, and so on, it can get a bit unstable. So it might be that you try to run Solver with one asset allocation as your starting weights and it can't find a solution. And if you change those weights, it might converge on a solution. So if Solver's being a bit difficult, try to play with the initial weights and try to run it again. And if it gives you an outcome first time, it's probably still a good technique to do it again with a different initial set of weights, just in case it converges on a different solution. Right? So just play with Solver a little bit and be prepared that it might take a little bit of time for Solver to find a solution. What data are you going to use, quarterly or yearly? What is my time period? And in part, that's going to be constrained by data availability. So for example, if you use quarterly data, you need to make sure you have data for every asset class for your whole period. So if you wanted to consider the use of hedge funds and you're using this data, you could only start in 1999. But what I'm going to show you next week is how to backfill hedge fund data back to where there is yearly data available, which is December 1988, which means you can extend your sample period. So if that was the case, you probably would be constrained by inflation-linked bonds data for quarterly returns starting in 1991. Now, that doesn't mean you need to start your analysis in 91. You might decide to start it in 95. But whatever you decide, you need to explain why you've chosen that sample period in the report. And be careful in making it too short, because you might actually lose some of the extreme events, for example, or you might undermine the statistical power of your tests. So I would recommend no one started in 2005. What are the assets you're going to consider? And for all of these, you need to justify your decisions in the write-up. You should use the same analysis method for each client, but if you have a very strong reason to believe that one client is better suited to a yearly bootstrap and one client is better suited to a quarterly hypothetical portfolio, you could do that, but you'd need to really convincingly argue why that's the case. Because remember, Abigail and Robert are a couple. They're going to look at this report and say, well, why did you do that for him and this for me? Right? So if you use different methods, explain why. All of this is the stuff that's going to happen in reality. You only need to use one quantitative method, but you can have more than one if you want for robustness. Right? But remember, you've got a page limit. So if you want to do more than one and see whether the same method, two methods will give you a similar output, that's great. It may earn you extra marks if you do it well, but you've got to balance the fact that that's going to take more space in your write-up. Just doing extra work is not going to automatically give you more marks. It needs to be well done, it needs to make sense, it needs to improve the quality of your report. You need to apply your qualitative considerations to get your final asset allocation, as I said before. You need to build knowledge of your asset classes because you need to provide an overview of all of the asset classes in the portfolio. And you need to write up your report and leave enough time to do it well. Okay, so in terms of what you can do now, you can already do the first 3 tasks. The third one, setting up your quantitative analysis, remember you should heavily rely on the first 4 or 5 Excel videos because they've actually been structured to help you with the assignment. As you start to do the quantitative analysis, issues will come up. When you can identify them, that's when you want to start to ask for help. If it's help that I can provide everybody, I'll incorporate it into the workshop. If it's specific to your spreadsheet, I'm happy to have a look at your Excel work to see what's gone wrong. And for your qualitative adjustments in particular, you probably want to understand all of the different asset classes before you have a final recommendation. So I would be aiming to write the report over weeks 9 to 11. That gives you a good 2 weeks to do it. And don't worry about leaving some sections blank till you feel confident filling it in. It's sometimes good, though, to early on start your framework, and then you can fill things in as you go. Any questions?